Is the U.S. economy in trouble? The growing rivalry between China and the U.S. The rivalry between China and the United States has long been a key feature in the global economic and geopolitical landscape. But in recent times, tensions have escalated, with both nations using their economic power as a strategic weapon. This increasing strain raises a pressing question. Is the U.S. economy really in trouble? Or is this just another phase in a long-standing rivalry? Recent reports show that U.S. stock markets are struggling, with a significant drop in tech-heavy indices like the Nasdaq. What's causing this? Why are tech stocks plunging? And why is there growing concern among investors? The answer lies, in part, in China's advancements in artificial intelligence, a sector that has been rising rapidly and threatening to shift the balance of global power. Investors are becoming anxious, fearing that China's developments in AI could further disrupt the already tense relationship between the two countries. At the heart of the conflict, on one side, is the Trump administration, which sought to protect U.S. dominance in global trade and finance. On the other side stands China, determined to expand its influence by strengthening its production and export capacities. Both sides have wielded powerful tools in their economic arsenals, such as tariffs and diplomatic strategies. The recent news that China had wiped out a massive $1 trillion from the U.S. economy has caused a stir. This shocking development has led many to question whether the U.S. economy is on the brink of a significant crisis. When Donald Trump assumed the presidency, with his America First mantra, he promised to tackle the trade deficit with China and protect American workers. He introduced aggressive policies, including tariffs, which targeted Chinese imports and tech giants. This, in turn, laid the groundwork for China to reduce its investments in U.S. bonds and stocks, causing a ripple effect across the financial landscape. But as expected, China didn't back down. It retaliated, creating a challenging environment for American farmers and businesses. The global supply chain was also disrupted, leading to higher costs for American consumers. The real blow to the U.S. economy came, however, when China began to sell off U.S. Treasury bonds. This move, often discussed in theory, has now materialized, sending shockwaves through financial markets. The sale of such a large volume of U.S. debt has led to fears about the stability of the U.S. economy. A loss of a major buyer of U.S. bonds could lead to higher interest rates and more expensive public debt, which would place further strain on the U.S. economy. When the news broke about the $1 trillion loss, many were left wondering whether this was a sign of impending disaster. The immediate question on everyone's mind was, did China really manage to wipe out $1 trillion from the U.S. economy in one fell swoop? While it might sound dramatic, the truth is that such fluctuations in value, though unsettling, don't necessarily mean an economic collapse is imminent. However, it's not entirely without consequence. The loss of a major buyer like China has certainly made its mark on the U.S. economy, even if it doesn't spell the end of the road. This situation isn't as simple as just China selling off bonds. The global financial system is highly interconnected, and such moves have far-reaching consequences. When China pulls back from buying U.S. debt, Treasury bond yields rise. This means that U.S. taxpayers will ultimately bear the burden of higher borrowing costs, and the cost of public debt will increase. Financial markets, already sensitive to any sign of instability, are now facing even more volatility. In extreme cases, the stock market could experience rapid declines, losing billions, or even close to $1 trillion in a matter of days. So, while it might seem dramatic to hear that $1 trillion has evaporated, in reality, it's a reflection of a much larger, complex issue at play. Donald Trump's attempt to tackle China's trade surplus through tariffs has not yielded the results he promised. Rather than successfully reducing the trade deficit, tariffs have created additional damage on both sides. American producers have been hit by China's retaliatory measures, while American consumers are now facing higher prices due to disrupted supply chains. Trump's promise to win the trade war with China hasn't materialized as expected, and his tough rhetoric has failed to achieve its intended goal. This brings us to another point of reflection. How much of an impact can China's actions really have on the U.S. economy? While it's true that the U.S. remains the world's largest economy, it's no longer immune to external shocks. China has made significant strides in diversifying its markets and reducing its reliance on the U.S. The question of whether the U.S. is truly in trouble rises. Can the U.S. withstand the growing economic pressure from China? The answer isn't simple. On one hand, the U.S. has vast reserves of technological innovation, defense capabilities, and the strength of the dollar as the world's reserve currency. But on the other hand, the U.S. is not without its vulnerabilities. The U.S. economy has faced crises before, and it will likely face them again in the future. However, there are concerns that China's rise could weaken the U.S.'s economic standing in the long run. With public debt at record levels, there is growing anxiety about the country's ability to roll over its debt if interest rates continue to rise. This could potentially lead to a wider deficit, further exacerbating the economic situation in the years to come. Serious analysts caution that if large reserve holders like China reduce their investment in U.S. bonds, it could trigger a recession. In the U.S. economy, this prospect, while not immediate, looms large despite the challenges. The U.S. has managed to weather difficult times in the past. However, questions persist. Could the U.S. economy face trouble rolling over its debt in the future? Could fluctuations of this scale, like the $1 trillion loss, eventually lead to more severe consequences? The truth is that large-scale economic fluctuations can eventually trigger serious problems, and the current volatility is indicative of deeper structural issues within the global financial system. Another significant issue is the ongoing trade imbalances. China continues to run record trade surpluses, while the U.S. remains in a persistent trade deficit. Despite Trump's efforts to reverse this trend, his policies have not been able to stem the tide. The question arises, has Trump's strategy failed completely? While bringing some manufacturing back to the U.S. may help in the short term, it is unlikely to change the fundamental dynamics of global competition. Multinational companies, driven by the desire to minimize costs, are not likely to move all of their operations back to the U.S. in response to tariffs. Furthermore, China's investment in new technologies, including artificial intelligence, has only strengthened its position in the global marketplace. This has led to increased competition in areas like algorithmic trading, which can create immense volatility in financial markets. A sudden drop in tech stocks like those in the Nasdaq can cause billions of dollars to evaporate in a matter of hours. This kind of volatility is precisely what led to the $1 trillion loss, which, while unsettling, is a reminder of how fragile the global economy can be. So, is the U.S. economy in trouble? The answer is complex. While the U.S. has a robust economic foundation, China's rise and the ongoing trade rivalry are causing significant shifts in the global financial system. The U.S. faces challenges, particularly in terms of rising public debt, increasing volatility in financial markets, and trade imbalances. These issues could eventually contribute to a slowdown in growth or even a recession. As the rivalry between China and the U.S. continues, it is clear that the future of the global economy will be shaped by the economic power struggle between these two giants.